All right, so you are welcome to the part 2 of business income. In the part 1, we try to understand the sources of the income of a business, and we also did, most importantly, the deductions allowed and the deduction disallowed. All right. So what you need to get here is that most importantly, when you talk about the deduction disallowed, or the deduction in general, let's say deduction, we said that the Section 9 applies, the residual deduction rule. All right. So please remember the residual deduction rule. So the residual deduction rule, if you remember, we talked about the new acronym. All right. So new. Okay. So the thing must be what? Necessary. All right. Without which you cannot produce an income. The thing must be exclusive. All right. It must be towards a particular thing, and that is the business. All right. In terms of its objective. All right. So here is purpose. All right. So the purpose. Then wholly is expressed in terms of the amount. All right. So the amount. Okay. So if some part of the expenses is for personal use other than the business use, we focus on only the business use. So that will be the one that will be allowed. So the personal side will never be allowed. In fact, Section 9 also talked about the fact that the expenses should not be of capital nature. All right, capital nature, which means that if the thing is of a capital nature, what is an expense that is of a capital nature? We said in the part 1 video that the expense for which the benefit will be enjoyed more than 12 months or over a year. Okay, so that is that. So if it is a capital nature, then it means that we should use it for capital allowance, not as an allowable deduction. So the expense should not, all right, be of capital. No, it should not be capital expense. All right, so that is what Section 9 taught us. So we went on to do Section 10 interest. We went on to do Section 11 trading stock. We did Section 12, 13, 14. We did all those things, even up to bad debt. All right, so please, we are now coming to apply them in solving the question. So let's start with question 1, which is November 2019. We are giving Valentine Ghana Limited is a producer of love greetings card, and the following are extracted from the financial statement. So we have the sales, we have the stock, we have, this is the opening stock, we have carriage invoice, we have what do we call it? Carriage invoice is that we have purchases, we have closing stock, we have cost of sales, we have gross profit, other income, trading expenses, tax paid in last year. All right. So what do we do? What's your approach? Your approach is that you come and pick the net profit. All right. The net profit they had before tax. Okay. So net profit. So whose company are we preparing this thing for? Is Valentine. All right. Or Valentine Ghana Limited. And what are we supposed to actually do? Let's read the requirements of the question. It will instruct us what to do. Calculate the chargeable income. So you will say computation of chargeable income. All right. Then you can put there for year of assessment 2018. All right. 2018. So we put that there. You underline nicely. All right. We are not giving the basis period of the company. So and the basis period of a company has to be given, okay? Because it is the accounting year. All right. It is not like an individual where you have to do what do we call it? The calendar year. All right. This is a company. So you start with the profit after tax. So what do we have here? Net profit. Not is profit before tax. All right. So please let me correct that statement. So each time you have it, just take it net profit. All right. That is what they call it here. So net profit per account, the account that you have. So always start with that one. Put it here. We have 346, 110. Then you come in with your adjustments. So you write adjustment. So the things that they deducted that they shouldn't have deducted, the things that they added that they shouldn't have added, those are the things you are going to deal with. All right, so let's start. Let's start. Of course, as for these things, every company is allowed. Remember, one of them, section 11, talks about you deducting closing stock. Yeah, and it's fine. So everything is fine. There's no problem here. Gross profit, other income. What goes into the other income? The story might tell us. Operating expense, so something like this, tax paid for 2017 should never be allowed. It's not an expense, all right, allowed to be deducted. Okay, so that is that. Those things, even in partnership video, you saw it. Tax paid, all right. Then this is for a previous year. Then we also have fines, penalties, all those things are disallowable expenses. So here we have capital allowance. You know what we use it for. Then the figure in the repairs and maintenance included an amount of 33,150 being the cost of erecting a new gate. So you see something like this, you have to disallow it because gate is not something, it's not a revenue expenditure. It is actually something that can last for more than 12 months. So we have to add that one too back. Okay, so that is that. 50% of other income was personal rental income of the managing director. It is personal. So we have to compute the 50% and add back. All right. 1/3 of the vehicle expense was expended on personal. That one to 1/3. All right. So that is that. It says that 1/3 of the vehicle running expense was expended on the personal car of the managing directors used for the company operations based on the company's policy. So it is trying to tell you that inside it, they spent on the managing director, but here the car is being used for the company operations. Okay, so that 1/3, no, he used it to work for the company operations. So can we then conclude that if that is the case, 2/3 wasn't for? We can't conclude that, but it is just a story to trick us. So we have to let it go because he is actually using it for the business. All right, that is that. It is even though it is his personal car, he used that car for the company. All right, so that is that. Okay, so what are the adjustments we have already? We are told that repairs and maintenance. So you start from the notes. Repairs and maintenance. There is a personal part inside there, which is 33,150. We are adding them back. We will add this one back. All right. Then what else? We also told that 50% of the rental income. What is the rental income? Oh, it's 50% of the other income, right? That is it. Percent of other income was. So what is the other income? We have to add that one back. So please understand that all these things have already been done before you arrived at this figure. So if there is something you are adding back, when we say add back, the meaning is that what they deducted before, okay, or what they added before, you are negating it. So for example, this one was an income. Inside this income, that has helped them derive this final answer you pay. There is part of that income that should not be there. That is all. And if it is an expense, they deducted certain expense, then there is part of that certain expense that they shouldn't have deducted. So if they shouldn't have deducted expense and they deducted, you're going to add it back. They deducted, you add it back. it cancels it out. All right, that is the meaning. Okay, so for example, this one that is an income is 156 400. So if I do 0.5 of 156 400, I get 78 200. So that 78 200 is part of something they added here. I am going to deduct it. All right, so you negate it. So 78 200. So this is how it will be. All right, so that is that. Just understand from that analysis. All right, what else do we have in there? 1/3, but this 1/3, like we said, it was used for the company purposes. All right, so that is that. Okay, so now we pick that one. You solve the note part. You now come in which other ones like this tax paid of last year. If you paid tax for last year account, why have you come to deduct it in this year account? I mean, it doesn't make any sense. The fact that you paid in this year doesn't mean it's for this year, because tax is paid in arrears in Ghana. It was respective of 2017 account. Why have you come to deduct it in 2018 account? So you will add it back. You will add it back. So that is the way you should be understanding. Yeah, electricity bill is for, it applies. Section 9 is okay. This one to rent and rate, everything, office expense, yes. Motor vehicle running, yes. Depreciation, you will add back your depreciation because the GRA will give you capital allowance in place of that. All right, so that one is 149,940. All right, so you add that one back. Provision for bad debt, general. I told you in the part 1 video, it is only specific that is allowed. So provision for bad debt, general is added back. So general, how much is that? 154,020. You add it back. Stationery, yes. Every company needs stationery to work. Medical expenses, yes. What else? Cost of servicing, yes. Yeah, all these things are expenses that you could see that every entity are allowed to, bear. Okay. Late filing to just like the tax thing. We can't allow you to benefit from a penalty. So if we allow, everybody will do the bad thing and treat that as something they can actually be allowed to enjoy. So this is what you do. You do all the adjustments. Okay, we've done the adjustments. So how much will we get for the total adjustment? 33,150 plus minus 78,200 plus 289,000 plus 149,940 plus 154,020 plus 61,880. Okay, so together I have 609, 790. You can actually shift all these things to these places, okay, and add it. All right, so that is that. Then I have capital allowance. It's an allowable deduction, capital allowance. So here too, the question can be given to you in such a way that you have to go and compute the capital allowance. The capital allowance here is 204,000. So this is the capital allowance you are allowed to do that. How much is that? 204. So if I less 204,000 from this, I am having 405,790. Okay. So what do I have here? If I add it to what I have at the top plus 346,110, at the end of the day, what I'm having here is 751,900. So this is what we call the chargeable income. Chargeable income. So we are done. All right. So it's just you knowing which ones to add back, which ones to deduct. That is what these things are about. All right, so that is all. Okay, there is a B part to the question. It says no deduction is allowed for domestic or excluded expenditure incurred by a person. All right, identify 4 items that constitute domestic. Of course, domestic is what you spend at home. Domestic is what you spend at home and what you do for yourself. So you can name any of them. I mean, you can form something like the one you used to buy your clothes personally. Okay, the one you used to eat personally for yourself. I mean, everything you spend on yourself. Okay, you can also talk about the one you used to maintain your personal car. I mean, these are domestic things you used to buy your utensils at home, everything, your security for your home. All these are domestic. Then we have those things that constitute excluded expenditure. So excluded expenditure is what we did here. For example, this one, tax paid for previous year. Depreciation is also excluded. Provision for the general one was excluded. Late filing was excluded. So all these things, all right. In a way, we are trying to tell you disallowable expenditures. Okay, so that is that. If you paid a bribe somewhere, it's excluded and all those things. All right. So that is that. Anyway, it says that explain briefly the taxation rule governing research and expenditure. We did that in the part 1 video. First of all, you have to say that for any deduction to be disallowed, or for any deduction to be allowed as a deduction, it must meet the residual deduction rule, which is the new, necessary, exclusive, and wholly, and it should also be what? Not a capital expenditure. But when it comes to research and development, the law actually says that because it is research and development, whether it is capital expenditure or not, it is what? Allowed as a deduction, irrespective of whether it is capital expenditure or not. So please, that is for research and expenditure. That is the only one that that kind of overcomes the research, the B part of the residual deduction rule, which means it's a capital expenditure. But even in mining companies and petroleum companies, it is disallowed. But it's just that in a normal business year, that one is allowed. All right. So basically, that is that. That is that. Okay. But when we say research expenditure, we are talking about when we say research, it's talking about creativity. Okay. So you trying to do something to bring some initiative that will improve your production process. All right. But so if you use the money to buy an asset, in which will indirectly help you to develop do your research and expenditure, that one is not part of. Please take note of that. That one doesn't mean it's a research expenditure. You bought an asset. All right. So expenditure incurred on the purchase of an asset to do research and development. The focus is you bought an asset. All right. So that is that. That one will be disallowed. All right. Thank you. So basically that is that. Write those things and you are fine. So we have another question here. Question 2, similar like our question 1. Okay, so it says that Stella VD's manufacturer of fruit juice in a local market commenced business on this. So this thing is something you have to take note of, this date. You have to be very, very careful and take note of it. In these cases, that means that if you are going to compute any capital allowance, you have to be careful because of this date, okay? So that's that. The company submitted their account in 2017 and was assessed accordingly. The company was submitted tax returns for 2018 year of assessment, and they did that on this date. So below are the tax details. So we have gross profit, and there is other income. Probably they will tell us something on that. We have expenses, wages and salaries too. There's something on that. Okay, these are directors' remuneration. We will talk about all these things. All right. So we have to talk about these things one by one. Printing, telephone, installation of plants. Without two, there is a note on it. Registration and licensing, depreciation, business promotion, legal fees, staff welfare. We will look at that. Donation and subscription, and publicity. All right. The advert and publicity, the advert, normally we have something we call neon signboard. All right. Neon signboard. All right. There is additional information. It tells us that the advert and publicity. So you are doing the publicity for the business. So you did radio, you did news adverts, then permanent signboard at the company's entrance. You see, this is it. You see, this signboard will be there for more than a year. So this one will go for a capital allowance. So take note of that. That one will go for capital allowance. Let's just keep that thing down. All right, let's just note that one down. Okay. Then installation. So it means here we have to add this one back. The 18,000 will be added back, and we will let it go for capital allowance. Then the installation of plants. Installation of the plant costs this. So you have 21,500. That's the installation of the plant. This one too is a plant. We know that plant is a PPE. That one too to be fit a capital allowance. Heavy duty generator brought. Okay, that is another one. It's a heavy duty generator that is brought to support. That was bought in 2018 to support the plant and machinery. So that is a heavy duty machine. So you ask yourself, if there is a heavy duty machine, then that one too is might go for capital allowance. All right, then we have general expenses. So as for general expenses, it is a general expense. Okay, so that is that. Then we move on to the next batch. Staff medical bills, safety wear of these people. Then canteen equipment. So you see another one. So canteen equipment is also another thing that is going to capital allowance. Donation and subscription. Goods given as gratis for custom officials. Imagine, do you know what gratis is? Oh goodness. So they gave it to the it's like what we call facilitation money, right? So you give it to people to facilitate the activities of the business. All right. Gratuities are recognizable. Anyway, it's interesting. It's interesting. So they are recognizable in Ghana, but my good friends, please, this one too is a disallowable deduction. So I won't put it in this color. Let me pick it in another color. All right. So that is that. It's like facilitation, bribe, let me call it like that. Please, all those things. Donation to goods to SOS children. Okay, that is a contribution to a very well to us because there's association paid to Ghana Association of Industries. Okay, so if they don't pay, they can't even operate. So that is that. Somebody will say the facilitation fee to if you don't pay, you can't go on with your business. Interesting. All right. Then we have fresh graduates employed by Stella. So there are old staff, and this is fresh graduates. And fresh graduates constitute 0.9. All right. So when we did the tax planning, you realize that we have a provision for what do we call it? Fresh graduates. So if you pay fresh graduates, we have ranges. Okay. So in business income, you have to understand the concept of fresh graduates. All right, this is called activity variable of the when we talk of tax planning. So you have fresh graduates inside your business. Now, what happens is that for those fresh graduates, we have when they are kind of up to 1% of your business, we will give you a tax relief, allowable an additional tax relief of what we call 10% of the wages and salary you pay to those people. those fresh graduates. And if they are like above 1%, so above 1%, but below or not exceeding 5%, you get 30% of the wages and salary. Then if they are above 5%, then you get 50% of the wages and salary. All right. Of the wages and salary. So this question, we are fortunate there is a fresh graduate, and that fresh graduate that is inside the question is telling us that they are 0, so they are not up to 1%, it's 0.9, and you have this. Okay, so what is going to happen? Well, what is going to happen is that you look at it, and since it fall here, you compute 10% of the wages and salary. All right. So compute 10% of the wages and salary. 10% of 26,000. That will be 2,600. All right. So basically that is that. So that 2,600 will be given to you as kind of a relief, all right, for your business. And that is the one that we call it is an additional relief, an incentive. All right. So that is that. That is that. So even though these are the total expenses that the person, there is an additional expense that he's supposed to get again. So you add to the expenses 2,600. That one is given as an additional one, free of charge, to reduce the tax liability of the person. So we will do something about this fresh graduate. Let me color it. Then other income, we are told that compensation that was received from cancellation of a sale order. So you canceled a customer canceled the sales order and you had this. That is good. Then the compensation for loss of trading stock. Sorry, that is 10,000 also. So what do we call it? You lost trading stock of 10,000, and what is happening is that perhaps you are gaining that. Then there's another compensation for cancellation of purchase order by a supplier. So inside all these things, the one that probably you should take good note of is probably the one that concerns the trading stock. All right, that concerns the trading stock. So these are your other income. Then you have the capital allowance. So you see they've given you. So what you will be doing is that this is in 2017, right? So what you'll be doing is that you have to take your time and go and do capital allowance of 2017 before you can arrive for the capital allowance for the 2018 year, which we are preparing the account for. Okay, so that is that. That is that. So you have to do class 1, class 2, class 3 for all of these things. So it is best that, I think it is best that when you get these questions, you first get your capital allowance done. So get your capital allowance done first, then you can move. So let's go and do the capital allowance. This means that this question should give us the full 20 marks. Oh, yeah. So they've even separated it for the capital allowance for the respective years. So let's do the capital allowance, the A part of our question. So what is the name of our company? Let's go up, find the name of our company. Stellar VVD. Stellar VD company. Then you come here, computation of capital allowance. So we have our year of assessment, and it is 2017, because that is where we started from. And I told you that, take note of this. So if the company started in this date, I think we've been doing this before, and we always get 92 days, right? 30 days have September, April, June, and November. All the rest are 31, except February, which has 28 days or 29 each leap year. So 30 days have September, April. So October will be 31, November 30, December 31. If you add them, it's 92 days. So be mindful of that. Be mindful of that. So you realize that our basis period here is spanning from October 17 to 31st December. All right, so that is that. So we have to bring in our classes, class 1, class 2, class 3. Is there class 4 in this? Let's go and check. Factory building is class 4. So it means that you have to create factory building. Hey, this one is supposed to be class 3. So we have factory building. So let me just class 3. So class 4, we don't call it, we call it by their name, the asset itself. All right, so that is that. And we have here plant and machinery. So this one is class 4. Plant and machinery is the plant and machinery used in production. And this is a manufacturing company. So we will say yes. So we will put it in class 2. Then we have plant and delivery van. Delivery van 2 will be which one? Yes, let me guess from you. Yes, also it's a car, class 2. Computer, class 1. Furniture and fittings, class 3. Other office equipment, class 3. Then office building again. This is factory building, this is office building. So, and that one too is in 2018. So it means that the class 4 assets are 2. So we have there's a freezing of this. Wow. So we have factory office building now. Okay. Is there any other assets? So let's now add the assets. Okay. Do your best to now add all the assets that you need to add. But don't forget there were some assets inside here. So the company submitted a tax return for year 2018. All right, year 2018. Okay, and in the year 2018, there are certain assets that you probably see there. So you have to be very, very, very careful in the 2017 year and in the 2018 year. So in all these things that you have, signboard was in 2018. Generator supporting was in 2018. So you have to be very, very careful because this in 2018, you will be doing them as an addition. All right. So be very, very careful about those ones. All right. Then what else do we have? We have, okay, these ones are not assets. Okay. So that is that. So in our 2017, what do we have for the class 1 assets? So you add all the class 1 assets and you bring them all together in the 2017 year of assessment. So this is bought in 2018. This is bought in 2018 also. Okay, that's fine. So let's pick the things that are here. So if I take my class 1, the only thing we had in class 1 is this, right? So that will be, class 1 will be, we have cost 40,000. So the percentages are 40, 30, 20, 10, 10. Okay. So, and let's not forget to bring our CD sign too. Very important. So 40,000, you have to put some zeros there, please do. So this is 40,000. Class 2 assets as at this date. Class 2, we have 171. So find a place and add it, okay? 171,000. Then delivery van, 50,000. Okay. These are all class 3. This is class 3. Okay, so that is what we have. That is what we have. Okay, so together, oh, let me punch it again. 171,000 plus delivery van of 50,000. That is 221,000. So that is basically what we have. 221,000. There is an additional one, of course, you saw, but that one was bought in what? 2018. 2018. All right. So where is it? We have this plant. Okay. So the 221 we have here, we have a plant that is bought in 2018. What about this installation of plant? What was the date? Do we have any date for that? Installation of plant and others in 2018. So I mean, this one too is something in 2018. So normally, you know that an asset, when you have an asset, what you do is that all the costs incurred in bringing the asset into each useful state are added to the cost of the asset. So here we have the installation of a plant, so which was also in 2018. So if it is in 2018, then it means that when we get to 2018, please don't forget that you have to be adding those ones because those are the additions that you have inside the financial statement. Don't forget them. Don't forget them. All right. So that is that. So let's move on. So how much do we have then? I have 221. Okay. Then we have office building also. Office building. Before the office building, we have these furniture and fittings and all those things that were bought inside the other year. So these two, which is amounting to 300 and how much? 350, right? So that is how much that one to be, 350. So that is how much we have. And we were given another thing. Where is that? New signboard of how much? 18,000. So we will find out where we add this one because this thing is something of permanent nature. So it will be part of the class, what do we call it? The class 4 items over there. So we can create even another one because it's something of permanent nature. Okay, so that is that. So we will create another one for those ones too. All right. So and this thing is happening also in 2018. So just make sure that you get to know the dates things are happening because if the thing happened in 2018, you can't really make it like you are going to add it in 2017. It's I mean, I don't know how sensible that thing can be. All right. So ladies and gentlemen, take note of that. All right. So how much was that? 350, right? 350. Then the last one, office building. You see, the office building here is in 2018. So it means that there is nothing we can do for that. Then what about the other one? That one too was in 2018. The signboard too is in 2018. Okay. So we will chalk on those ones. All right. We will chalk on those ones. All right. So what is the capital allowance? All right. So capital allowance 40% on 40,000. So how much will we have? 0.4 by 40, 16, right? Yeah. Don't forget, this date is 92. So multiply by 92 over 365. So that is giving me 4,033. So that is what I have. So it means all the capital allowance here, you'll be multiplying it by their rate, but it should be 92 over 365. So be very, very careful. All right, so the same thing so we have 0.3 multiplied by 221,000 by 92 over 365. And that one too is giving me 16,711. I'm rounding them. Okay, 16,711. Okay. Then 350 is 20%, right? 0.2 by 350 multiplied by 92.365. So that one too gives me, let me multiply it by 1,000 so that I can get 17,644. So that is what I'm having. 17,644. 17,644. Okay, so that is what I have. Then the factory building. So the factory building, we had two. One was so this one was just 300,000. That is what we have. Then there was the 18,000 that was there, was rather in which year? 2018. All right. So we have 18,000, 300,000 here. Those ones are 10%, so it's just that. So that is what I have here. We don't have any office building yet. So that is that. So total, my capital allowance for the year 2017. My capital allowance for the year 2017 is how much? Yeah, I think I made a mistake here. I forgot to do the other part of it. So the other part of it was what? It is 300,000. So you see, sometimes you can even make a mistake by 10%, which is 0.1, it gives you 30,000. Then the 92 over 365. So I nearly forgot that. So let's correct it. So please be careful. All right. So 7,562, what I will have rounded. All right. So that is that. Let's close it out. So that is 2017. Now, but what we are doing now is actually 2018 financial statement that we have. So I think we will pick one of the depreciation that we will need for that year 2018. So let's do this computation. I still have the final answer on the final answer of the 10%. So that one will be 7,562. If I less that, I have 292,438. So that is what I have. That's my WDV. So let's start. 40,000 minus 4,033. That gives me 35,967. And I have 221,000 minus 16,711. So that gives me 204,289. Then I have 350,000 minus 16,644. 17,644, sorry. So that is 332,356. All right, so these are the WDVs that I have. Okay. So immediately I can sum up all the capital allowances for 2017. So I had 4,033 plus 16,711 plus 17,644 plus 7,562. Then that gives me a total of 45,950. All right, so that is the capital allowance. That is that. Then we come to 20 year of assessment 2018, and over here it will serve a full year. All right, because the basis period will run from 01 2018. This is 17 to 31 12 2018. So I'll start with my WDV brought down. Of course, this is it. 35,967 204,289 332,356 292,438. Then the additions that were done in the year. So additions. First of all, there was an addition of office building in the year. On this date, they bought this 500,000. Please, we don't use these days to do any. The date of purchase is irrelevant to us, okay? So if you buy an asset even on the last day and use it to produce income, you get full capital allowance for that. All right, so that is that. Don't worry yourself about the date, but the date the business commences is important. What about the additions? So it means we've utilized this information. We have to go to the top now. Those ones that we took notice of. Okay. So even the signboard, we can create another thing for the signboard. Okay, we can create it for the signboard. They said that they built a signboard. So you can create another one, signboard. Or you can, since this one is bought anew, you can also add it here. Okay, can add it to this one. But I don't want any. So let's just do it like this. All right, so that is that. The signboard. So it means that your answer booklet, you can do the, like I taught you in the capital allowance video, you can do 1, 2, 3. All right, then you do the 4 and 5 2 after you are done with the 1, 2, 3. The addition, yeah, we've done. There was no computer addition, so there's no addition for computer. Installation of plants and heavy duty also to support heavy duty generator also to support the plant. All these things happen in 2018, and these things are in class what? Class 2. So it means that we need to add those two as an addition. So we have 21,500 plus 2,500. So that gives me 42,000. So say in our income adjustment, we will have to add these ones back. All right, we have to add these ones back. They are part of the expense that shouldn't have happened, deducted. Since they deducted, we will add it back. So please, that is that. We will add it back. All right. So that is that. What else? What about class 3? Was there anything in class 3 we should add? I saw some equipment, canteen B. Where are you? Canteen. This is fresh graduate. I think I highlighted it. So where is it? Equipment for canteen, 12,000. So that one should also be there, 12,000. It's class 3 as an addition. All right. So basically that is that. There is no addition here. So let's do our capital allowance quickly. So first of all, the depreciable basis will be what? 35,967. Depreciable basis 246,289. This one too is plus 12,000, right? So if I add, so here will be 4, 4, 3, 3, 5, 6. This one is the same, but don't forget that those ones are 10% on straight line. So it doesn't matter there. So that is why I prefer you always do those ones separately. Because if you don't take care, you might go and use you might go and use reducing balance for them. All right. So capital allowance. So for this one, it will be 40% reducing balance. So 0.4 by 35967. That gives me 14386.8. So let's round it and make it 14387, right? Immediately, the question said I should calculate capital allowance. It didn't say I should do the entire table, so I can even stop here. It means that the other ones are not necessary. So I can actually stop here. Pen has frozen. Let me pause then. All right, so let's continue. So if I quickly deduct, like I said, you don't really need to do that, but it's not part of the requirement of the question. But since you have it on your laptop or your calculator, we just do that. So 35,967, you minus, it means my balance here will be 21,580, right? So that is that. Then here, the same thing, 0.3, that's 30%, multiplied by 246,289. All right. So I have here 73,887 rounded. So immediately I can deduct 246,289. But this figure that I'm looking for is not part of my requirement, so you can ignore 172,402. Okay. This one too is also on reducing balance. So 0.2 multiplied by 344. Why are we not doing 9290? Because this one, it starts from January, all right? So 365 by over 365. So this one will give me 68,871. All right. So if I want to deduct directly, 344,356. Is in exams, I don't encourage that you waste time in doing this final value determination because it doesn't add anything to your answer. Don't waste your time to do that. Here, it is straight line method, okay? And so what do? We have 30,000, okay? So here, it is straight. It is straight because the capital, there was no addition, but the capital allowance is the same thing you do all the time, the same thing. So here will be 30,000. This side will be 50,000. And this side will be what? 1,008. So if you want to go ahead and do it, I think this one will be 450. Then this one will be 262,438, right? Then here will be, let me see, 18 minus 1.8. That gives me 16,200. So that is that. But we are not interested in these figures. We are interested in the capital allowance. So what is the capital allowance? So the capital allowance that I have here is 1,008 plus 50,000 plus 30,000 plus 68. So plus 68,871 plus 73,887 plus 14,387. The total capital allowance thereof is going to be 238,945. So if we are not giving capital allowance for 2018, this will be the capital allowance that will affect our figures that we had over there with. Okay, that is that. All right, so basically that is it. All right, so we've done the A part of our question. Let's go to the B part of our question. Okay. All right. So the B part, we are now coming to do the business income thing. So it's still Stella VVD, Stella VD Company, Ghana Limited. So the second part of our question asked us to do something. It it asks us that we should compute chargeable income. So computation of chargeable income. And the year of assessment is 2018. And the basis period, therefore, will be the accounting year. 31st December. So you see, be careful of the exam question, because you have to always remember this accounting year. Because it is that reason why we made this one 92 days. If the accounting year had gone to September, we wouldn't have used September the following year. We wouldn't have used 92 days. So be careful, all right? These things I discussed in the earlier videos, all right? So please be careful, all right? So that is that. That is that. All right, so we will come with here with the adjusted profit. So here, let's do the net profit from the account. How much is that? 516,800. So we have to do some adjustment. And please, my best advice is start with those things we adjusted in the notes. So for example, permanent signboard. We have used that figure in computing capital allowance. So it means that we have to take it out here. Installation of plant. Heavy duty also. Generator. So we have 21,500. Then we also have, you see here I'm deducting, we are adding back, sorry, supposed to be added back. Wow. Because those things were deducted, we are adding it back. Sorry for that. They were deducted earlier, so we are adding it back. So this one was 18,000. We have installation of plant. If we deduct, it means we are double deduct. So it can be 21,500. Gen set 20,500. All right, so that is what we have. Okay. Then what else did we touch? Canteen equipment. We used it. That was 12,000. So, and you can continue with this gratis, the bribe, this, they deducted, we have to add back. It's not something we should encourage. Wages, they deducted this money, but they should have deducted more. So, like I said, the benefit that they will have. So it is below 10%, 1%. So it will be 10% of how much is that? 26,000. So that is an incentive that you have as fresh graduate. Okay, so your old staff is how many? They have 26. We weren't giving the number, but we were giving the percentage. So they deducted fresh graduates. Of course, they are supposed to deduct. It's an expense, but they should deduct more. They should deduct more, and they deduct only 26,000. So which means that they should reduce the expense more. Okay, it's an allowable deduction. So since they didn't do that, we will do it on their behalf. We won't add it back. We should deduct more. We should help them. It's a relief that they should get. All right. So basically, that is that. So let them enjoy that relief also. All right. To reduce their profit that you are going to tax. All right. So what basically this question is telling us is that in the wages and salaries that they deducted only these two, which is okay because it's wages and salary. But the fact that they have employed fresh graduates means they should go ahead and deduct more so that their profits would have reduced. Okay. So basically that is that. Other income, in compensation from cancellation. So they had from a customer canceled some order, and because the customer canceled the order, he had to pay. That's fine. It's an income towards the business. Compensation for loss of trading stock of the company. This one too is under, it forms under capital allowance. It forms under capital allowance. Whereby it's not really like the classes of the capital allowance, but it is just about the fact that you had proceeds from disposal of a trading stock. All right. And these things are discussed. If you remember, in our discussion in the business income, we talked about the fact of, what do we call it? Section 11, trading stock. For loss of trading stock, any income that you receive is part of your income. So they did the right thing. So that is fine. And they said compensation for cancellation of purchase order by a supplier. So supplier to also purchase, they canceled it. And that is, so this is 15. So doesn't mean our other income is 33. 23. Okay, it's correct. 23. 23. Yeah. So then it means that there's nothing really wrong about what they've done. There's nothing really wrong. So we have to let those ones go. All right. Let's let those ones go. All right. So that is basically that. There's nothing to even temper with. They are genuine revenues that the entity should, other income that they should have. All right. So then they've done it over there. So there's no problem for us. All right. Has it been that these things were not concerning the business? We would have probably tackled them separately, but this is all regarding the business. So it means that we have dealt with the notes. So let's go back to the list that were provided. Is there any other thing that we should take note of? Donation, staff welfare, we've seen it. Legal fees, yes. Business promotion, yes. Every business should do that too. Then depreciation, because in place of depreciation, you'll be giving what? Capital allowance. So depreciation, you add back, how much is that? 2,700. So what else again? After depreciation, registration and licensing. Okay, registration and licensing of what? If it's for the business, yes. One thing you should understand is that we need to find out what this registration and license is for, because the license or the registration, those things that you use to commence a business shouldn't be part of this. So, but we don't know what kind of registration this is. Is it registration for what? We don't know. But I'm going to operate on the assumption that it is the registration and license probably they use to start the business. If that is the case, these are not revenue expenditure. All right. So you have to base on whatever assumptions that you will use. Is it registration? Because registration and license is not our operating expenditure. Okay. So that is that. So I'm on the basis that this is the registration and license of the business. That is the only reason why I'm adding it back. So that is the basis. So it will be 12,100. All right. Then we've tackled this. Postage, yes. Electricity, yes. This, yes. Directors' remuneration. So this one too is another thing. You have to know which directors are those. So since it's directors' remuneration, we assume that it's one of the executive directors. All right. So basically that is that. So we will deduct all these things from the profit and add those ones that we are supposed to add. So what do I have? I have 15, 16, 5, 16, 800 plus 18,000 plus 21,500 plus 20,500 plus 12,000 plus 13,000 minus 2,600 plus 2,700 plus 12,100. So in the end, I have 614,000. 614,000. Then the capital allowance that I less capital allowance. All right. So the capital allowance, which one will I use? Of course, the 2018. In the law, remember we did capital allowance. You said capital allowance cannot be carried forward. Remember, you cannot carry forward this capital allowance. So please remember, these are law. So we are picking 238,945. That is the one for 2018. So let's go and pick that one. So we have here 238,945. So when I deduct that, it means my final answer is 375,055. All right, so that is my chargeable income. All right, so that is that. We are done. That's all. So have you seen how business income is done? All right, so that is how you carry through your business income. Ladies and gentlemen, that's all. If you can't do all, do most parts. All right, so basically that is that. So learn through this. May 2021, you have profit before tax. This is it. Finance gain and finance cost. Okay, this is another thing we learned over there. And it says that explain the treatment of derivative under the company. It says what constitutes finance cost. First of all, what constitutes finance cost? Finance cost is about derivative in our law. So it's interest and the losses that you get because you have engaged in financial instruments. So that is what finance cost is. All right. And the losses are deductible. The finance costs are deductible. All right. So that is that. But remember, what did the law say about deducting finance costs? It says that you will do finance cost will not exceed, it shall not, the allowable finance cost shall not exceed what? Finance gain and plus what? 50% of the adjusted income, right? That is adjusted chargeable income. All right. So let's call it adjusted chargeable income. So that is what the law says. So you have to apply the law. All right. So first of all, you explain what the financial cost is. Then you what constitutes finance cost. You have explained, and the tax treatment is what I've just said now. All right. So, but it's different when it is a mining company. That is why the question says neither a mining or a petroleum company. It's different when it is a mining company. The treatment is different. If you are doing this thing in level 2, we don't do mining and petroleum in level 2. So you shift that one to somewhere. So that is the tax treatment. So we are supposed to compute and explain the allowable tax cost from derivative. So like something like this. So what do? You will do the adjusted. So this one wasn't adjusted. So we are the ones who are going to do the adjusted. How do we do the adjusted? So you will pick the profit before tax, which is 132. All right. This means that these two weren't inside this. Okay. They were, so the following, it says that the following were included in the net profit. So it means that they are inside. So it means whatever answer we will have will determine whether we should add back or we shouldn't. All right. So if they were inside, for example, finance gain was inside, it was a gain. So we will add back. A gain was actually added. So we will less. So the one that we will add back is the cost. All right. Because the costs were deducted. So again, we less the finance gain because it was added before. So we will take it out. It's what? The gain is 42,000. Then the loss we add back because it was deducted before. which is 300,000. All right, so we are looking for our adjusted, though, don't forget. So if I take 132, then I less 42, then I add back 300, it means I have 390,000. So basically that is what I have, 390,000. Then I'm now coming to do my finance cost. So the adjusted, so allowable finance cost, how is it going to be? So we said that that thing is finance gain. Here, finance gain is 42 plus 50% of the 390. So 50% by 0.5 gives me 195. Then I add my 42 to it. So it means that the allowable finance cost should have been 200 and what? 37,000. But they deducted 300,000. So what then do we do? Which means that our the finance cost treatment should have been, so we will have profit before tax of 132. Then the finance cost that were, so because the law said it shall not exceed what? The finance gain plus 50% of the adjusted chargeable income, we will add back that thing they deducted. How much did they deduct? 300,000. Then we will now less the proper amount they should have less. Less how much? So 237,000. In another stretch, somebody will also say that I will do 132,000. Then I will only add back the difference between the two three, which is 63,000. The difference between these two. So at the end of the day, we will all arrive at the same answer because this one will be 195, right? And this one too, if you go ahead, it's still 195. So basically, that is what will happen. That is what will happen. So that is what you will get. Okay, that is what you will get inside. All right. Then if there is any chargeable income in there, any other what we call it, other information, you can continue from there. This thing can be inside or part of what we've just did. It can be one of the additional information. All right, so please be careful. Be careful. So you do the adjusted chargeable income. You do 50% of that, 195. You add it to the finance cost, which gives us 200. So the finance cost they deducted shouldn't have exceeded 230. So it means that what is going to happen is that you add back the finance cost. All right. So the question is that what happens to the finance gain that is already inside? The finance gain that was already inside. Nothing happens to the finance gain that was already inside because it is something they added, and that is that. All right. So you do this, you are free to go. And it says that assume all the facts are the same, but the finance gain is what? 60. Then it means that, and the finance cost is for 30. So basically they want us to do it again. that is that. They want us to do it again. Now, if you want us to do it again, the same approach. The thing is 132, right? So we are finding the adjusted. So we will less the gain that they are referring to here. What is the gain? The gain is 60. Then the cost we will add back is 30, right? So the gain we are lessing is this. So this is it. So I have 132 minus 60 plus 30. That gives me 102,000. So finance gain was 60 plus 50% of this. So divided by 2. This is 51,000. All right. So 51,000. What do? I add it back. It gives me what? 100 and let me just add plus 60. 101. So this is the allowable one. Okay. But there's the cost was 30. So it means what they did was, okay, we won't do anything, we won't touch anything. So what will happen is that those things that were already deducted is correct, because they deducted it because it was lower than 101. All right, so that is that, because the law said it shall not exceed. All right, so what they had was lower. So that is that, we won't touch anything, everything is fine. That's all. That's all. All right, so ladies and gentlemen, we are good to go. So you realize that here, since it was over, we added, this is it. So what the law says is that, you see this, they had 300,000 in this case, but we would disallow 63 of it. Now, what the law says is that the part that we have disallowed, you roll it over for the entity for the next 5 years. All right. So we roll it over. So the 63,000 that you have will be something that will be allowed to carry over for the next 5 years. So that's what you say. Carry over the 63 over the next 5 years. Awesome. All right. Then we have a B part to this question. And I think this will be probably the last question that I'll tackle. There are so many here, so you have to take your time and go through. If you want a copy of this book, please, you just have to pick the number. All right, contact me and you have yours. So let's go to the B part of the question. So what we have is that they have a revenue, cost of sales. Yes, they should do that. They've done that. Rental income, gross, of course. And that is another thing. Everything that is in here must be at gross. So if the question gave you net, you gross it up yourself. All right, gross it up yourself. Be very, very careful about that. So you have to gross it up. All right. Then as part of the other income, there's rental income, gross, dividends, gross, gross interest, yes. All right. Then operating expense, they've left it and basically have, so it means that this is how this place should look. It has to be an underline. All right. So basically that the following information has been adjusted to the operating expenses. So this operating expense included these things. Depreciation, we will add back. Penalty, we will add back. Fines, we will add back. Refreshment. So if the refreshment was for, everybody, that one, it is what it is. So was for everybody as an entity. In the individual person, it will not be taxed on the individual person. But here too, refreshment will be disallowed. So you add it back. Okay, can't allow you to spend money and enjoy, be top like that. Then, so it means there shouldn't be any underlying here, because this is also for tax paid. All right. So that is that. That tax paid should also be added back. So they are basically showing us certain things to add back. The dividend was received from Z Limited, a resident company, where he owns 27%. Okay, so this is what the law says. So it's another thing about business income. If a resident entity, all right, invests in another resident entity, whereby his investment in there is more than 25%, okay, he shall not suffer a withholding tax. There will be no withholding tax on dividends received, because both of them are resident, okay, and this is not a bank. It's not a financial institution. So what is going to happen is that, you see this clearly, there wouldn't be any withholding tax. All right, so that is what the examiner is trying to show you. All right, so basically that is that. All right, so what do? We pick up our profit before the net profit. Please remember to write the names. The net profit is how much? 215. 100. Then clearly we have all these things to add back. So adjustment. We will add back depreciation. We will add back penalty. We will add back fine. We will add back refreshment. We will add back tax paid. Tax paid is not an expense. It will just be deducted from the money, the tax payable. All right. So it's not an expense. So here we are adding back 10K. We are adding back 2,000. We are adding back 500. We are adding back 1,005. We are adding back 16,500. All right. So make sure you add all those things back. All right. So that is that. Then what do we have here? These things, these ones, the additional income. You see, rental income is a investment income. All right. It is not a business income unless the business is in the course of their business is a rent business. So rental income is not a business income. So for example, if they have done the net year, we will gross it up, and with this one it is added, so we will deduct back. All right. Rental income is not a business income. Watch your withholding tax video well. You realize that rental income is an investment income for businesses that are not into rental business. It's an investment income. So it can't be part of this business income assessment. It's an investment income. So please, that one, we have to deduct it. 120. It shouldn't be part of a business income. All right. Then dividend. So the dividend too is another thing. Dividend is from investment. It's an investment income. You don't get dividend from business. We get dividend from investment. All right. So that one too is not a business income. So it has to be out. All right. So that one too is 20,000. Gross income from treasury bill is also an investment income. So that one too has to be out. So please, here, what we are doing is business income. All right. So all these things, they have to be out, because what you realize is that, so how much is that? 41,000. Those things are taxed separately. For example, rental income is taxed 8% withholding separately. All right. So that is that. So be careful. All right. So guys, let's total. So we have 215, 100 plus 10K plus 2,000 plus 500 plus 16,500 as a tax paid, minus 120,000, minus another 20,000, minus 41,000. So that kind of give me 63,100. All right. So that is what I have, 63,100. All right. So basically, you go through this, and after all these things, you have your balance. All right. So that balance that you have, you now come and talk about the others. Of course, we had this rental income. So rental income will suffer a final dividend of if it is a business commercial rental they did, it will be 15% or 8% if it is. But in the case that the company is a real estate that gives rent, it means it is their service that they are doing. So that one would have suffered what? 7.5% tax. So that is something you need to know. To one person, it is 7.5 as a service. To another person, it is an 15%. To another person, it is what? 8%. 8% for residential, 15% for commercial. Then 7%, 7.5%, if that thing is a real estate, or the person is into the business of giving rent. All right. So that is that. Okay. Now, dividend, of course, we talked about the fact that dividend too will suffer 8%, but this dividend, the question told us that it is between a resident entity and another resident entity, and that one is exempt from withholding tax. All right. Then gross interest from treasury bill, income from treasury bill, we don't pay tax. All right. So that is basically that. All right. So what do we do? What do we do? Basically, that is what we have. So if there is any interest on the other, if it is another this thing that is not a treasury bill, another income that is not from a treasury bill, what you do is that for a business, they will have to pay a tax on it, a withholding tax of 8%. For an individual, it is 1%. So please know the dynamism around these things. All right, just know the dynamism around these things. What did the question ask us to find in general? Oh, okay. Okay, so this one we have to tax in. This is the chargeable income. All right, we have to tax the chargeable income, an amount of how much? An amount of 25%. So rent income dividend interest is final. This is a treasury bill. All right, treasury bill. So if you invest in a treasury bill, like I said, if it is any other investment income, that one you have to tax it at 8%. So what you do is that you do, after you have assessed the business, you bring the tax that they will pay on that side. So this one, we are going to tax him at 25%, which means you are going to pay a tax of 5775. All right, so basically that is that. Just make sure that your computation here, you've added the right things. All right. So, and I tell my student that anytime you finish, you can finish early for this kind of thing. So double type again. So if you are like me, do 215 again, 215 100, you add back the 10,000 again. Then you add back the 2,000 again. You add back the 500 again. You are just double checking. 1,005. You add back 16,500. Okay. So even when you do that side alone, it gave me like, so this side alone was 245,600. So you write that one down. Then you come now and you less the 120,000. You less 120,000. Then you less 20,000 again. Then you less another 41,000. That's all. You get, well, it's actually imagine. So like I keep telling you, just do it, go over. This thing is actually 64,600. So you see, so multiply by 0.25 again. So the tax they will be paying is 16,150. All right. So that is that. 16,150. And again, you remember, so the other taxes, you will do it aside. You do those ones aside. So if assuming that, so he said that explain rent income and dividend, we've explained it. So dividend is 8%, but because it's a resident company investing in another resident company, whereby the investment is 25% or more, then it means it will be exempt from the tax. But if it's below, you will tax at what? 8%. That's all you say. The rental income is taxed at a withholding tax. If it is commercial, it is 8. If it is commercial, if it is 15%. Resident will be taxed at 8%. But if that thing the person is doing is a service that he does, then he will be using a rate of what? 7.5% as a service. That's all. That's all. All right. All right. So that is that. So if a business investment in treasury bill, all right, this is treasury bill. But in Ghana, but if you are to pay interest on these things, and please, these figures are gross. These figures are gross. If they were supposed to be net, you gross it up to get the gross. All right. So if a business is paying interest on a treasury bill, it will go for 8%. All right. But it is a treasury bill. Okay. It is a treasury bill. All right. Any other investment income, please tax at 8%. All right. So please, what you need to do is to try more examples. This is another one. All right. So try more examples. A question can be loaded. You see a question like this. Question like this has 20 marks. You see capital allowance. You see, we have put 3. Okay, so maybe I should solve this last question. After this one, okay, these ones are done already. Let me do this last question with you. Then I'll end the class. So the questions reads that the following extract relates to the financial data of Thierry Limited, a company resident in Ghana with a basis period from January to December. All right, that's fine. Thierry Limited estimate tax returns for 2020 year of assessment is as we see. So we have sales, we have cost of sales, gross profit, other income. Then we have these expenses. So there are some notes on the expenses. Depreciation, for which we add back staff costs, publicity, directors fee. So the directors fee, which directors are those? So these are questions you normally should ask yourself. All right. So if it is a director's fee, if it is for non-executive directors, we know that the company paid for those. All right. But normally, if you are paying for those, you are supposed to withhold tax. So we don't know whether this is gross or net. So we can assume that this is for the executive directors. So if it's for non-executive directors, we would have done the withholding tax and all those things. Repairs and improvement, there's a note. Donation, there's a note. Penalty and fine, I mean, you have to add it back. Interest charges, there is a note. Subscription for newspapers, there is a note. You know that by law, every company is supposed to be buying newspapers every day. Yeah, because if you don't buy, you don't say there wasn't any communication. Daily Graphic is and Daily Guide also is the two state recognized graphics. So that's why you see that every day some companies have graphics, even when they don't read it, they buy. All right. So interest on loan to the MD. So the interest charges, there's a loan to MD. Okay. So we will take care of that. It's personal. It's personal. All right. You took a loan for MD. You are charging this thing as part of your the expenses, the interest on that loan as part of your deductible expenses. No, you will not allow that. Foreign exchange loss on loans, yes. Yeah, so that one too is fine. If it is, we will do finance cost on those things if it is a, what do we call it? If it is financial instrument, this is not a financial instrument. But even with this one, 2023 law has come to deal with this. But this question is in 2022. All right, and those things were discussed in the video. All right. Now, what I will do is that I will talk about some small amendment that has happened, especially on finance cost here and on relief losses. I'll talk about that. All right. So finance cost on relief losses. I have to talk about that before I wrap up this video. The new law for 2023, which started in May. All right. Bank charges, of course. Osu Children's Home donation is a worthwhile cause. Pastor Azigi Church is not recognized anywhere. All right, so this one will not also be allowed. We have to add it back. Laboni Senior High School, yeah, that's a good thing. National Disaster Management, that's a good thing. Political party fundraising, no, that one too has to be added back. All right, so that is that. It's not a worthwhile cause. All right, so please, that one too has to be added back. Okay. He said that an amount of 200,000 disclosed in the account was paid for repairs and maintenance. Don't forget, repairs and maintenance should not exceed 5% of the WDV, all right, of an old machine bought years ago. It is hoped that the performance will be enhanced after the improvement. So what is the WDV of that old machine? We have to find the WDV of that old machine. All right, then we will do the 5%. Creditors of the company agreed to cancel an amount of 120,000 standing as part of credit balance as an incentive to the company. So the company is now getting an additional 100. And it says that this has not been taken into account, all right, in the GRA tax return. The amount is how much? 120,000. So in effect, these people are getting an amount of 120,000. So creditors, all right, meaning that the company owed some people, and those people have decided to give it the money free of charge back to the company as an incentive. All right. So that is some kind of money that you are getting. All right. So that is that. An amount of 300,000 being the cost of a price of goods were issued to a related party outside Ghana at cost. The margin on these things, on these goods were weighed. The margin of the goods weighed was cited as 120. So they sold it at cost. Please, revenue should be at what do you call it? At selling price. So it means that 40,000 that they waived off is an additional revenue. Okay, so and we have to bring it back. They had that revenue, so we have to bring it back. All right. So that is that. That is that. Tax paid was 20 on account. So if we get their tax liability, we will deduct this. And the book capital allowance unutilized certified by from 2019 was 300,000. It is unused. So the question is that can we bring it forward? So these are capital allowance issues we will discuss once we get there. All right. Capital allowance agreed. Capital allowance agreed with GI after taking into account all relevant issue was this. All relevant issue, that means this one too is included. So we won't, when there was the new law, if you had old capital allowance, you are allowed to transition the old capital allowance because of the transitioning of the new law. All right. But here the question said that everything has been, all right, after taking consideration, even in this one. Yeah. So what we will do is that I said pool 3 had a written down value on this date. Do you remember we said that there was something, repairs and maintenance of something. Where are you? There was a repairs and maintenance. Wow. This is it. Of an old machine. Old machine is in class 3. So we have the WDV brought down of an old machine. This is the machine. So we will do the 5% on the WDV. So that is what will happen. So when we do 5% on the WDV, this is the opening balance. So we will do the 5. We would what is that? What this means is that this is the opening balance. We will do capital allowance and do 5% of that WDV. Then we will actually treat the capital allowance that we get from that one. All right, so that is that. Then it says that an allowable debt has been included. An allowable bad debt has been included in the selling and distribution for 2019, amounted 100,000. The company recovered the amount in 2020, but no transaction has been recorded. So this is bad debt recovered. It's an income. All right. So that is that. Bad debt recovered. It's an income now. And again, Cherry disposed of its capital as a 250 to the managing director. The cost of the thing was 300 as they were acquired 2 years, some years ago. An investigation revealed that the market value of the thing is 350. The company has already included the loss in, so the loss was what, 50, yeah? All right, no problem. The loss was 50. It means that we should capitalize, expense another loss again. Another loss, because the loss they would have done here is only 50. So we have to add extra 50. All right. Or reduce the loss. So this is it. This is, they did it. They sold it off to the manager at this. All right. And the cost of the thing was this, which means that an investigation revealed that the market value of the thing was this. So it means that they actually, so this is it. When they were disposing it of, they disposed of proceeds were 250. But the proceed actually should be 350. So that is that. And the cost of that thing is 300. 300. So this is 50 as a gain on disposal, which should go there. Then what they did here is they recorded, it says that the company has already included the loss. So the loss here, the loss is 50. They included the loss of 50. So it means that that 50 must be brought back. All right. There wasn't anything such as a loss they should have deducted. So you add back, then you actually consider this part. All right. So basically, this is a gain. This one will go to gain. This one you add back. All right. So that is that. I think those are the things. So let's now consider the issues there. So the capital allowance to of the W. So the WDV brought down. We are doing for 2020. So it says that the WDV at the beginning of 2020 was 4 million. All right, so that is what we will have now. So if we do this now, we are now going to do capital allowance on this. So it's class 3, right? So class 3 is 20%, so 0.2 by 4 million. That is 800,000. So the WDV brought down will be 3.2. So now we said that, so this is the WDV. Carry down. So we said that the repairs and maintenance should not exceed 5% of the WDV. What is the 5% on this WDV? So 5% of WDV is actually 160. So 5% of WDV is 160. So the expenses, how much did they deduct? Repairs and maintenance. 200,000. So what will happen is that we have to add back this 200,000 and actually deduct only 160, sorry. Or you can decide to add back just 40,000. All right. You can decide to add back just the 40,000. All right. So that is that. Then if the allowable, what happens to the 40,000 then? The 40,000 that is disallowed. Any excess. All right. So here you will be allowed only 160 out of the 40,000. So that 40,000 that will be disallowed, what we say is that will be added back to the WDV as an addition. Okay, so those 40,000, you go and treat it as an addition and do another capital allowance. But herein, we say that the capital allowance that we were given included every form of adjustment done. So there is no need to go and calculate for any other capital allowance. So have these notes down. Let's just go and start. So you write the name of the company. All right, that company that you are working for is Thierry, right? Thierry Henry. So computation of what? Computation of tax payable. for year of assessment 2020. All right, the BP, the basis period is also this. All right, so let's go and pick the profits. Then we come back to the note and we adjust the note first, then come back to the figures and see what we will do over there. Now, the net profit here is what we are picking. All right, so net profit per account. How much is it? We have something like 2, 4, 2, 1, 620. So that is what we have. Let's do the adjustment. So for the adjustment, let's go and start from the notes. So we've already seen how much. So what will happen is that we will add back repairs and maintenance. We would add back the entire 200,000, but the one that is allowable. So allowable deduction. So you can just add back 40 if you want, okay? The allowable deduction is 160. So in effect, you can just say we are adding back 40. That's all. The creditors agreed. The creditors also cancel something, which is an additional income. So compensation for cancellation. So creditors. And because the question said this has not been taken into account. Another income the entity earns. Any income associated with the business. All right. An amount of, yeah, this one too, we did it. What was our conclusion? They deducted the loss, right, before. So that loss, which was an error, we need to add back loss on realization. It wasn't supposed to be a loss, right? So since they deducted that loss, we need to add it back. All right. Oh no, that is not the one. This one is different. An amount of let's do the loss first. We come back to that. Then this one was a gain. There was a proper gain, all right, which they have not recognized. So the gain on realization is another profit. So they have not recognized that gain. We are actually recognizing that gain. They only recognize an incorrect loss. We've added back. The proper thing they should do is what we have done. All right. So that is that. Then it says that an amount of 300,000, all right, being the costs were issued to a related party. The margin on these things was 40 in correspondence with that. So they didn't disclose this 40. So we should record the 40. Okay. You can record the 340 as the selling price and deduct the cost as the 300. So at the end of the day, we have the margin on related party sales. So it's a gain. So you add it. They didn't do it. We are doing it. If they had done it, fine. All right. Then tax paid on account, we would use it as a deduction on the person's tax. The company has a book capital allowance. So the proper capital allowance for deduction too is this one. Okay, so this one would have been in, but they said that capital allowance after taking into account all relevant issues, all right, all relevant issues. So we will use this as our capital allowance. I think the repairs, have we done that? Yeah, we've done the repairs. Okay, that was the first thing. Then bad debt recovered. When it was a bad debt, we allowed you to deduct. Now that it's recovered, we have to bring it in as an income. How much is that? 100,000. All right. No transaction has been made. That's why we've done the transaction. And this one too, we've taken care of it. All right, I think we've taken care of everything now. Yeah, basically that. Now, so this one is done. You take this one is done. You take it. We've used this one, so it's just the capital allowance that we are yet to actually deduct from the thing. So after we get everything, we can deduct. Then what again? We would have considered the effect of this, but everything after taking into consideration everything and the tax paid too. So let's then go up to the table, what we need to add in addition to it. Political fund, this thing is also something we should not encourage. So add back. So donations to politics, 90,000. Disaster management, yes. Pastor Ziggy. Hey, donation to Pastor Ziggy, 30,000. To interest you that these things happen in Ghana, to interest you, they actually happen in this our nation. All right. Then the personal one. Okay, so interest on personal. You see, Section 10 says that any interest that you incur because you borrowed money to foster your business is an allowable deduction. That's Section 10. And this one, they borrowed from outside Ghana and they are also incurring an exchange loss. So that one too is an extra deduction. So this is the one that think capitalization helps you to deal with. Think capitalization, exchange loss on something like this. All right. Other than that, for now, it's good to go because they didn't take it from a related party. So nothing like think capitalization. So, but the interest on the personal one, the MD one, you can't take loan for your MD and deduct it from the company income. It shouldn't be allowed at any point in time, not at all. All right. So that is that. Subscription, cool, interest charges, we dealt with that. Penalties and fine, you should not be allowed for that. Penalties and fine. So they deducted it, you add it back. How much is that? 50,000. Donation, we've dealt with it. Repairs, we've dealt with it. Director's fee, like we discussed. Advertisement, yes. Staff cost, depreciation. Depreciation. So how much is the depreciation? The depreciation too, we have that is big money. 2440. Ladies and gentlemen, per what we learned the other time, something like the gain on this gain, you can decide not to bring it here. You can tax it separately. If it is from investment, you can tax it separately. All right, if it is from investment at 15% separately. Okay, so that is that. I think we are good to go. So let's the other income. Yeah, we don't have any business with the other income. So it may come from trading. So we don't have any business with that. All right. So ladies and gentlemen, we are good to go. Let's add all these things up and see what we got. And don't forget, we have capital allowance to deal with and some tax they paid already to also deal with. It's time to compute. We have zero zeros at all the end there. Okay, so I'll do 200 minus 160 plus 120 plus 50 plus 50 plus 40 plus 100 plus 90 plus 30 plus 500 plus 50 plus 2440. Total is 3,510. 3,510. So I add my 3 zeros. Then at the top there, well, how much do I have? 2421. That one has 620 to it. So I'll add my 620 because I didn't type all the 3 zeros. So it will be 5931, then I'll add the 620. All right, don't forget we have some capital allowance to deduct. So how much was the capital allowance? I remember it to be something like this. Yeah. Yeah, after considering everything. So it means that I can still keep my 620 and do minus 1050. So that gives me 4881, 620. All right. So that is that. That is the chargeable income of the company. So this one was my capital allowance. Then I have the chargeable income, which of course the company pays tax according to this question. I saw some 25% in here. You just pay the tax charge will be 25%. All right. So 25% on what? On this value that we have. So I have to do now punch everything 4881 620 multiplied by 0.25. So the tax they are actually supposed to pay tax charges 1220405. That is what I have. Then they pay some tax already. So this is where we do the tax pay deduction. That's where when they add it to the expense, you have to take it off. All right. So that tax paid was how much? Should be down somewhere here. Tax paid was 20,000. Any tax credits they have. All right. So minus 20,000. So it means that the remaining tax they have to pay is this. So tax payable is that. All right. So ladies and gentlemen, that is how we go about business income tax. So if you have to do capital allowance in the question, do to get the capital allowance. All right. This one too says that we've done this already. This one says that for an expenditure to be desired, 3 things must happen in connection. Oh, the when. And it is 10 marks. Wow. 10 marks. The residual deduction rule. The new thing. We did. So necessary. So without which the entity cannot make. So just explain them. So please then take section 9 serious. Domestic expenditure excluded expenditure. We tackled it before. Also for 10 marks. Interesting. Very, very interesting. And this another question for 20 marks. Wow. This is very interesting. So this one too is what? A Nigerian investor in Niger Limited has the following financial information. What, with relevant computation, comment on the tax implication of transfer from retained earnings to share capital. Of course, this thing is a more of a level 3 thing. Level 3 thing. Remember, transfer to retained earnings is recapitalization of income. So if you transfer the thing from retained earnings to share capital, these are the tax implications. The tax implication is that you are adding to capital. By our law, any amount that is added to capital must suffer a 0.5%. We call it stamp tax or stamp duty. It is 0.5%. All right. So it means that, look at this. It means this is what happened. They moved the thing. So from retained earnings to this one, they moved it. So this is what they are trying to say. So if, let me see, 2020. So the law is asking you to determine the implications of those. All right. So I think this is where it's coming from. So that is that. From any reserve. All right, but anything that moves from retained earnings to share capital, what you do is that you pay stamp duty of 0.5 on the amount. So please, that one, it's more or less like a tax planning thing. Okay, these things are usually dealt with in the level 3 paper. But if in case this is what is happening to you, they are asking you to do something like this, then it means that you will have to deal with it. All right. So it means that their retained earning being this amount, and now is this amount, tells you that they've moved 150 from it. So it means you pay stamp tax on that money. So please be careful. So if it means that if it was 2022, it was 1350, 1.350, and in 2021 it has reduced, then it means that two things must have happened. It's either they made a loss in the subsequent period or they transferred, which this question is just trying to tell you that they did. So if they did, that 150,000 that they've transferred, you will tax stamp duty of 0.5%. Ladies and gentlemen, that 0.5% have been amended. It is now 1%. Okay, so please, I'll talk about the amendments now. We'll go back to those things. And that one is what? So 150,000 0.05%. So please, it's not 5%, it's 0.5%. 0.5%. So that means that the entity is supposed to pay 750 as stamp tax. Again, how does money get into stated capital? You see, capital is that you buy shares. When you buy shares, you become owner. Then over there, we tax you there. Any money that is introduced to stated capital, you have to pay stamp duty. Please take note of that. It's 0.5%, but think from May 2023 coming, it has been looked as 1%. All right. And I think that is where we are now. Now, again, the money they have as retained earnings should have been distributed to the shareholders, not directly go to buy equity shares. Then the shareholders would have bought the shares themselves. So we call something, that is section 58, subsection 3. We call something deemed dividend. Deemed dividend. So deemed dividend means that you have to pay 8%. It means that this money was dividend people's money for the shareholders. So you pay deemed dividend of 8%. So how much is that? 150,000 by 0.08. Deemed dividend of 12,000 has to be paid. So these are the tax implications. All right. So take note of that. Take note of that. All right. So that is that. So for example, these ones that their stated capital was 600,000, which have increased to 1 million. That one to you do a stamp of 0.5%. All right. So that is that. That is that. So this is all you are doing for the 8 marks. What is the treatment on research and expenditure? We've told you that first of all, the new must be fulfilled. The new condition must be fulfilled. All right. And the thing should also be of what? A capital nature. But research expenditure that you are using to improve your business processes, it doesn't matter whether it is a capex or what, a revenue expenditure. That one is allowed. However, any cost of assets used in the research process is rather not allowed. All right. So please take note of that. Take note of those things. Okay. So that is that. That is that. Explain the conditions under which interest is deductible. Of course, we also learned that one. The interest is deductible basically on two conditions. Condition number one is that the money you borrowed, you are using it for the production of an income. Okay. Or you also use that money to buy an asset for which that asset is helping you to produce an income. Okay. So please, that is that. That is that. The production is like the money you borrowed must be used for producing income. That is that. All right. So please take note of that. All right. So basically that is that. And you do these things, you get your marks, 20 marks. That's all. That's all. So please learn these things. Okay. This is another long talk example where you have to go through, add back those you have to add back and all those things. All right. So please take time and go through the example. Now, I said that I will talk about some amendments shortly. especially the finance cost. Let's go back to our business income notes, especially on finance cost, the new amendment. Okay, so this is one of them. Okay, so that one was for unrelieved losses. So let's go to the expenses. Let's talk about those expenses. All right. Okay, so we start with this one. The 2023 amendment on unrelieved losses. This is it. So it used to be that we had priority sector and non-priority sector, where for the priority sector it is 5 years and the non-priority sector is 3 years. And we mentioned the priority sector. But right now, the amendment from 2023 is saying that there is no more priority sectors or non-priority sectors. All that thing has been taken off. So you see, it must be noted that the amendment number 3 of Act 2023 substitutes this section. All right. And basically what it is saying is that there is no distinction between priority sector and non-priority sector. All right. So you shall deduct unrelieved losses for any of the previous years. So there is nothing like priority sector or non-priority sector. However, this is the interesting part. This is the interesting part. Now, if you have those unrelieved losses and those unrelieved losses does not apply to a person within the first 5 years of the commencement of his operation. So that is for this is interesting. Look at this. A person may be required to compute a tax of minimum of on the minimum chargeable income of 5%. So you not making profit for a continuous period of 5%, you will now, if you do that for 5 years, you are declaring loss for previous 5 years, you will be paying tax on the 5% on your turnover. So a chargeable income of 5% of turnover. What is turnover? Turnover is not profit, or it means your revenue. That is the problem. You pay 5% on your revenue for declaring losses for the previous 5 years of assessment. However, this provision does not apply to a person who within the first 5 years of his commencement of operation or is engaged in what? Mining. Okay, so it doesn't affect your first 5 years of operation. All right, so basically that is that. So that is the new amendment, and the stamp duty of stamp tax of 0.5% has also been amended. Okay, so that one too has also been amended to 1%. So, but your exams won't be in. I don't think the dates. So, if the exams is in the question is in 2023, then May and somewhere May 2023 coming, the new amendment will apply. But if it is before May 2023, the old things apply. So my guess is that depending on the year they want to do the examination, you apply the respective law. All right. So that is about. I'm sure your exams for now, exams that I've done will not be for 2023. I'm sure. But if you are writing your paper after 2023, let's say the date of the question is after 2022, which is 2023 coming, you have to apply the respective laws. All the new laws started taking effect on May. All right. So that is that. That is that. But the concession rates, like for example, the tax planning concession rates, which used to be 0%, which became 1%, from April 2023 coming, is now 5%. So you have to know these kind of things. So thank you very much. Solve more questions and you'll be good to go. God bless you.